Hello, everyone. I hope you are all good.
Hello, Professor.
Okay, let me just share screen with you. So today I'm expecting from you some questions before I start a new chapter. And this chapter will not be included in your exam. One more time, I would like to remind you that we are going to have the exam, which is on Thursday and 25th. And you will have one question, one comprehensive question, and you will write it. Basically it will be related to the cash flow projection, but with the different types of project like expansion, replacement cost, new product, and or new services that is penetrated to the market actually. So whatever we have done so far from the capital budgeting from part 1 to including 9, you're responsible for that. And plus at the end of the chapter questions that you had to solve it and you had to submit it.
Where can we learn about expansion projects, and could you just remind which lecture?
It's here. I mean, markers, all the expansion that's here from the beginning, all the cash flow projection. Actually, the cash flow projection we started. It was expansion. It was expansion, like the cash
we mainly talked about expansion. That's why.
No, we talked actually. We talked a lot. I mean, it's all the examples that we did. It's expansion, like you're expanding your business and you want to see how expanding and the new product and or new services actually almost the same thing in terms of estimating the NPV and estimation of the cash flow projection.
Okay, thank you. I got it.
Okay. Can you see what I'm sharing now? The Excel file is about to open. Can you see it?
Yes.
Yeah.
Yes.
Okay. So this is the book example. It's talking about the expansion project, okay? So all the Excel files are here, activity revision or NPV, and here the example of replacement and so on. And there's in the book, which is called with the cash flow projects with the cumulative net working capital as well. It's related to the expansion project as well, okay? So be careful, just pay attention to every single lecture that we spent in here. And one more time, if you will have any questions, if you have now, you can ask now. If you have while you're studying, please feel free to contact me via WhatsApp. It's here. I will be pleased to help you. So here's the WhatsApp and my mobile. And if you want to meet me, you can get an appointment. We can meet. There's no problem with it.
Meet like in person?
I mean, meeting via Zoom.
Yeah, okay, no problem.
So you just get appointment. You just say that, Prof, I want to meet with you this time. And if it's convenient with me as well, then there is no problem. We can just go together.
Sorry.
Yeah.
Is it possible to arrange a meeting today at 5 or 6 related to exercises?
Related to what?
Activity 7. I just there were many questions about solving them.
Okay, why we should wait it? You can just raise the question now.
No, there are just too many of them that
You want
I don't
to discuss?
want to take much of a class time.
Okay, I got it. Okay, let's discuss it. Just write me in the WhatsApp that you want to meet me at that specific time. We can meet, no problem with that. Okay, we just get in touch with me through the WhatsApp.
Okay, thank you so much.
Can I ask regarding the midterm?
Yes, of course, Nariman.
So I am questioning about do we have only 15 multiples and just it, or we have any additional one?
The midterm exam will be it's a midterm exam is not a multiple choice. It's not a multiple choice. It's an open-ended question. You have one big comprehensive example and you will solve it. But you will solve it in a way what we did it in the class. There's nothing like beyond out of the schedule.
It's like a case, right?
Yeah, you will be given a
we have
case.
one big
Yes.
problem, yeah?
Yeah, one big problem. You will read that problem. You will do the cash flow projection. You will do the MPV and so on. If it's a replacement, you will do a replacement. If it's an expansion, you will do the expansion. Estimate the MPV and answer the question like if it's a feasible, you should accept or reject the project and why not.
Only one
Sorry,
case, right?
Sorry, I just entered. Can you repeat, please?
Exam will be open-ended question, like open-ended question, which means that it will be given a kind of case, a one comprehensive example to you. There will be no multiple choice.
Okay.
And it will be on 25th at 7 p.m. Zoom conferencing is must, so everybody should share themselves through the video. So you will be asked to open the video.
And how much time will you give?
You will get more than enough, like around 1 hour something. But
Okay.
if you will need more, you'll be given more. But questions will be different. There will be 10 different types of questions. Almost everybody will have a different questions.
Sorry, we need to do it in Excel or right hand?
Right hand, it will be very difficult for you. It will consume a lot of time from you.
Okay, so Excel is okay,
Must.
yes?
Yeah, Excel is very, very preferable to you.
Okay,
Excuse me,
thank you.
could you repeat until what chapter should we, or what part should we? read?
Capital budgeting from 1 to 9. Like the whole chapter, capital budgeting, the whole chapter.
Okay, so no cost of capital, right?
No. The cost of capital, we're going to study today.
Okay, awesome. Thank you.
So we only have only cases, like only to solve case, right?
Yep. Only one case.
For 1 hour.
Yeah, maybe more than 1 hour, like 1.5 or something. I will see it.
Okay,
I have not arranged the question yet. Once the questions are arranged and prepared, and according to that, I will just give a specific time.
Thank you.
But the time will be more than enough. Okay. Coming to a subject, am I recording it? Yes, I'm recording it. Cost of capital. Cost of capital is the cost of using funds of the creditors or the shareholders. Creating value that requires the investing in a capital project that basically provides a return greater than the project cost of capital. So when we take into consideration the firm as a whole, and the firm creates the value, when it provides the return more than the cost of capital, I mean, the more than the cost of it getting this capital to use in a specific project, then we say that the firm is creating the value. Estimation of the cost of capital is very challenging. We must estimate it because it cannot be easily observed. We must make the number of the assumptions, and for a given project, the firm's financial manager should estimate its cost of capital. So the cost of capital basically is the rate of return to the suppliers, that the suppliers of the capital, basically if we talk about the capital itself, are bondholders, the one who provides the loans, and the owners, who are the shareholders of the companies. So this is a kind of compensation for them for their contribution in a specific project with certain capital. So the cost reflects the opportunity cost of the suppliers at the capital. So the cost of the capital is a marginal cost, which means a cost of raising additional capital. So more specifically, we call it as weighted average cost of capital, which shows that cost of raising additional capital with a certain weight that represents the proportion of each source of financing, which has been used in a certain project. So it is also known as marginal cost of capital. So sometimes in the questions you face the terminologies like WACC or MCC, which means the same thing, basically. It is the cost of using funds from the suppliers of the capital. Those who are those suppliers of the capital? They are the bondholder and the owners. The formula is given here, weighted average cost of capital. This is cost compensation for the bondholders, and this is cost compensation for owners. This both actually. This is for preferred stock and this is for common stock. W represents the proportion of the debt that the company uses when it would like to raise new funds. This is cost of debt before the tax, and it's adjusted to the tax, 1 minus T. This is proportion of the preferred stock that the company uses when it raises the new funds. This is cost of preferred and stocks, and the proportion of the equity the company uses when it raises the capital, and this is cost of equity. So our job in this chapter to estimate the proportion, to estimate the cost of debt and cost of equity in order to estimate the weighted average cost of capital. Weighted average cost of capital is the cost of the capital for additional raise of the capital. That consists of debt and the equity part. So we will basically learn how to estimate the proportion of debt, proportion of equity, and how to estimate the cost of debt and cost of equity. And when we finish measure of the leverage and the capital structure after this chapter, we will invite actually the head of the division of the advisory from the Tengri Partners Investment Bank, Mr. Talgat. He will just show us a real case from his investment bank. He will show us how they estimate the WACC and what is the best level of the capital structure should be kept to satisfy, I mean, the optimal level that could satisfy both owners and the managers. He will show us how it has been conducted. Then we will just replicate whatever he has done by showing us through the Excel function and so on. So we will do the same thing. But basically what we'll be doing is getting the theory into practice. And at the end, it will be done with the group, like up to 3 people, with the presentation supported. So you will prepare with the Excel function, you will estimate the WACC in a way that he has shown us, and you will do your presentation. So whatever he does in the class, so we will listen to him, we'll see, everything will be recorded and uploaded to the Moodle. We will just replicate whatever he has conducted to estimate the weighted average cost of capital and to find the optimal level of the capital structure for a certain company and give some advice. But it will be done in a group with presentation. And that will be considered to you as exam 2 that I was talking at the beginning of the week or last week. And all the guidelines and everything will be uploaded. And we are expecting to finish everything. I mean, the exam 2 with the project. Exam 2 is equal to the project at the end of the March. So at the end of this month, everything will be over related to the exam 2. Then we will start the new materials related to exam 3, whatever will be left. So we are expecting to cover 3 chapters: weighted average cost of capital, measure of the leverage, and the capital structure. Based on these 3 chapters, we will have a case project, which will be given from Tengri Partners as a real case. Suppose there's a widget company that has got the capital structure. So what I mean by the capital structure, how your asset is financed. We know that asset is equal to liability plus equity. How do you finance your assets? Through liability and equity. If your asset is 100 and your liability is 30 and equity is 70, this underlines the capital structure. So the summation of the liability and equity should be equal to the asset. This is how the capital structure is underlined. Does this capital structure is having an optimal level, like liability is 30 and equity 70? Maybe you have to proportionally change the level of the liability and the equity in order to get the optimal point where you get the maximum benefit of financing your assets. In order to answer this question, we will be able to do it when we get to the chapter capital structure and what will be the optimal level of the financing the assets. But coming before to that, we can see that the debt equity in here is 10. So debts and equity is 10 and 40 respectively. So the proportion and the total asset in here is equal to, who can tell me? What is the total asset in here? If the debt is 10 and the common equity is 40?
50.
Yeah, 50 is the summation of the debt and equity.
See.
So the before tax cost of debt is 9%, required rate of return on equity is 15%, tax rate is 30%, and what is the weighted average cost of capital? And this is WACC, basically what we have been estimating in MPV. When we discount the cash flow, we use some required rate of return, okay? We use the rate, and this is what we call it as a WACC. So in this chapter, we will learn how to estimate the WACC. So we are given everything. We are given the proportion, we are given the debt and equity, some capital structure, and we are given the return on equity, and we are given what you call it as cost
Sorry,
of equity.
Professor, one note about video lecture on
Yes,
Moodle.
please.
Residual income, economic profit, and the claims valuation, it's leads to wrong video. Data collection. Data collection.
Let me check it. I mean, the last lecture, this one?
Yeah, this one. Data
Let me
collection
just-
and organization.
Oh my gosh, it leads you to the... Yep. It's mistaken. I don't know why it has been put here, but anyway, I'll just fix it. Thank you so much. Thank you so much.
Okay.
I'll just fix it. But let me check it, but I have it here, residual income. Okay. And when we had it, just a second. It's related to data collection. It's not a course. Maybe I just mistaken. No, it's data collection. Okay. I should check the videos that I have it here. Because I remember I uploaded this file.
Yeah, it's in your channel.
It's in my channel, but I have not put in on Moodle, I guess so. Here we go. Yes, I just, it's some technical. Thank you so much. I really appreciate that you have I'll just change it immediately so that I don't put it for the last moment. just change it. To make sure. And by the way, when you get to my channel, just put some likes or comments to raise the attention to it. Thank you so much for your help in this case.
No problem.
Let me just see it. Yeah, it works now. Thank you so much. I really appreciate it. Okay, let's go further. So all the things are given here. Let me just make it bigger like this. Now here's the formula. Proportion of debt we need to estimate. Cost of equity is given. Cost of debt is given and cost of equity is given. Basically, but the cost of debt is given as before the tax. We need to adjust to the tax as well. However, if the preferred stock, if there is no information related to the preferred stock, it just directly becomes 0. So we're going to use this data. We just substitute the data into it. So what we need to estimate in here is only proportion debt and proportion of the equity. If our total value is 50, what is your proportion of debt? It's just 10 over 50. This is proportion of the debt. And how you can find the proportion of the equity is the same, like 40 over 50. This will give you the proportion of equity. Or you can just find 1 minus of the proportion debt. That would give you the proportion of equity. So 10 over 50, it's 20, and the remaining is 80%, the proportion of the equity. Cost of equity is given, cost of debt is given, tax rate is given. We just substitute and we find the weighted average cost of capital, which we are going to use in estimation of the NPV, or just in estimation the value of the future cash flow, like discounting them back. So when the widget company raises one more of the 1 million or €1 of the more capital, it will raise the capital with a proportion of 20% of debt and equity of 80%. And its cost will be 13.25. So this is the compensation that the equity holder and the bond holder, they require for their contribution. This is basically what it means. That's why we use the cost of equity, the cost of the marginal cost we're using here, or weighted average cost of capital. So interest on debt is tax deductible. So therefore, we actually adjust the cost of debt to its tax. So cost of debt, which is abbreviated as R&D, which is before of the tax. So before the adjusting to the tax. So we need to adjust. When we multiply, we just basically adjust to the tax, and we get after tax cost of debt. Then we multiply with the proportion of debt. So be careful. There can be cases, not in the exam, but in future, that in what way the cost of debt is given. Is it before the tax or after the tax? It's very important to know this differentiation. So the weights should reflect how company will raise additional capital. So ideally, they would like to know the company's target capital structure. What is the best optimal level that it could achieve? Where the capital structure is the company's goal, and we cannot observe this goal actually. So alternative, we assess the market value as company's capital structure component, and examining the trends in the company's capital structure and using the capital structure comparable companies. So when we get into the capital structure, at the end of the chapter, we will see how the proportion of debt is estimated if the target capital structure is not given. So these three methodologies are used. The first one, we will assess the market value of the company's capital structure components like debt and equity, and come up, this is the level they achieved, and it is believed that they're the target capital structure. Or we will examine the trends in the company's capital structure, how they have been changing throughout the history of existence. Or the third one, we'll use the comparable companies, like the companies from the same industry, whatever they have it, we're gonna just use their the average of their proportional debt and equity respectively. And we'll just apply it on a specific project, and we'll see that this is the, like, we'll assume that this will be the target capital structure. So weighted average cost of capital is the marginal cost for additional funds and additional investment. So in capital budgeting, we use the WACC adjusted for project specific to estimate the net present value, to estimate the value of the project, whether the project gives you some value. And NPV is basically net present value, which means all the future cash flows minus investment cost that is made today. However, there are some projects, they don't have any investment cost. So they have some future cash flows. What you will do, you just get the value of this cost, you will discount them using the WACC, and it will be called like present value of the future cash flows. So using the company's overall WACC, we evaluate the capital project and assuming that the project has risks similar to average project of the company. And these are the source of capital. This is the illustration of the formula, okay? Cost of capital, or WACC. It consists of cost of debt, cost of preferred equity, and cost of common equity. How we estimate the cost? We know how to estimate the proportion debt, okay? We understood. Either we can use the comparable companies, like using whatever given is as from the same industry, or we can see for the historical changes in capital structure, like how much of the asset is being financed by debt or equity in terms of percentages. This is what is called as proportion of debt and equity respectively. And the third one, we can use directly given the capital structure target by a company. So we know how to estimate the proportion. Now the turns come to estimate cost of debt, cost of preferred equity, and cost of common equity. Cost of debt is estimated through YTM or debt rating, but mainly we'll be dealing with YTM. Cost of preferred equity is estimated through return on the preferred stock and some variation because of the callability. So there are two methods to estimate the cost of preferred equity. And the cost of common equity is estimated through CAPE model, capital asset pricing model, DDM, dividend discount model, and bond yield risk premium price plus. So these are the methods, these are the approaches that are used to estimate cost of debt, cost of preferred equity, and cost of equity. And sometimes, not sometimes, frequently we will have the cases without preferred stock. So we'll be dealing only with cost of debt and cost of common equity. If you have cost of preferred equity, then we were going to use this one as well. So we're going to have some examples, but the real examples will be brought by Tengri Partners Investment Bank. How to estimate the WACC and how to find the optimal capital structure in real cases when they estimate a certain project, when they do evaluation on certain project. Okay. Coming to the cost of debt. If company has a publicly traded long-term investment grade debt, or cost of debt is determined used to determine the cost of debt, we use YTM, yield to maturity. If the company has got outstanding debt that does not trade regularly, and the cost of debt is estimated using the average yield of similar rated debt from the not from the same project, but they're similar to that. If rating doesn't exist for the company's debt, estimate the synthetic rating and refer to number 1. Alternatively, use the risk-free rate plus default spread approach. We're gonna use it at the end of the book. There are good examples, and within the chapter there are good examples as well, which we'll touch and try to see them in more deep. There is a very good example, which is very comprehensive one, like from the beginning estimation of the WACC. I'm going to go through that example as well. And that example I actually asked in the previous semester in the exam too. But in this year, I'm not going to ask because you're going to perform what you call it, a project based on the WACC estimation. If the company has the speculative grade debt and cost of debt is calculated using the CAPM model as well. So there are 4 different approaches that have been used to estimate cost of debt. Coming to the most 2 popular approach that we will be dealing with, okay, and they're more popular, they're mostly used in US and Europe. YTM approach. We are given a company that has got 100 million of debt outstanding and has got coupon rate 5% and 10 years to maturity, and it's quoted at 98. So basically it's about the bond value, okay, bond value. And this is quoted at 0.98 means the bond value is estimated at, so we know all the information, but we don't know YTM. We don't know the YTM. So basically in here, we should estimate the YTM, which is the cost of debt for the bond valuation. So if you estimate the YTM, you will actually get the cost of debt itself. So the marginal tax rate is 40% and assume the semi-annual interest. So it's easy to estimate the YTM using the financial calculator or using the Excel function. We can estimate easily. So there isn't much actually effort that you need to put to estimate the YTM. It's just straightforward. You just compute R and it directly, you just plug all the numbers and you compute R. It directly gives you this YTM, and this YTM is the before the cost of debt. And once you subtract the tax rate, when you adjust to the tax, and then it becomes the cost of debt of the capital after the tax. Okay, this is using the YTM approach. I'm going to show you the example in Excel, but later, not in this class today, but later when we get into example. Debt rating approach. Consider the company has got non-rated 100 million of debts outstanding with a rating of AA, and the yield on AA is debt currently 6.2%. And what is the after-tax cost of debt? It's a pretty much easy calculation here. You just adjust to the tax certain yields on a AA rated debt, and this gives you actually the cost of debt after the tax. Okay, the estimation of the synthetic rating is an alternative, is to play the role of the rating agency. So we'll rate ourselves, assigning rating to a firm based upon its financial ratios. And this is actually a bit complicated process, which we will not do, okay? We are not going to do it, but I will leave this part to Mr. Talgat. He will show us if there is a need to do it. So we will just basically will be dealing with the real cases, what has been done so far, and what is being doing now, how they're estimating their WACC. He will share with us this information. So to make this assessment, we begin with the rated firms and examine the financial patterns of the shared by firms within each rating class. So once synthetic rating is assessed, it can be used to estimate the default spread, which then added to the risk-free rate yield. And at the end, it gives you the cost of debt before the tax. And you adjust to the tax rate, you derive the cost of debt after the tax.
Excuse me, when will Mr. Talhat speak?
Sorry, when he's going to speak. First,
Yes.
the first speech he's going to deliver is, I think it's next week. Next week. I'm going to share with you. I think it's already shared in the KIMEP website. He's going to deliver in the class, okay, during the class. It's here. Just a second. It should be somewhere here. Here we go. Okay. Capital budgeting in practice. So he will talk generally in the first lecture. He will talk generally. He's not going to go in a deep with the WACC in the first lecture. He will give just introduction about the capital budgeting in practice in the first lecture. So what it means actually, and he's going to talk about himself and about the company activities that they're being involved in.
Okay, thank you.
Okay. So here's an example is given with the debt ratio. Okay. Sorry, no, with the financial ratio that has been used. Some of them debt ratio, some of them activity ratios to give the rating. So I'm not going to go deeply with this. It's estimated by the Moody's rating agency. So basically we could perform the same for non-traded company and assign a certain rating, and based on the rating to find default rate plus risk-free rate that could give us the cost of debt before the tax. Okay. But mainly we'll be dealing with YTM and debt rating approach, which is available on the market. Coming to this second part of the WACC, cost of preferred stock is straightforward. Cost of preferred stock is non-callable and non-convertible, is based on the perpetuity formula, which means infinite formula that doesn't have the number, a certain number of the years. So price is equal to dividend payment for the preferred stocks divided by rate, or the cash flows divided by rate. So there is example is given, the company has got the preferred outstanding, has dividend of $1.25 per share, and the price is $20. So what is the company's cost of preferred? So we're basically finding R here. Rearranging the formula, 1.25 divided by the price will give you the cost of preferred equity. If information is given, we're estimating the cost of preferred equity in this way only. There is no other way for estimation. Okay. And coming for the cost of equity, the methods of using estimation of the cost of equity is through the CAPM, through the DDM model, or and the third approach is bond yield plus risk premium. So first, we know how to estimate cost of debt is using YTM or bond yield plus risk premium. That would give you cost of debt. Second, if the information available related to the preferred stock, how to estimate the cost of preferred equity, we find it. And the last, what is left is cost of equity, which is challenging part of it. It is based on 3 different methods. So if sometimes you're required to use all the 3 methods to compare how the cost of equity is deviating from each other. Does it change much using the different methods of estimation of the cost of equity? So there's a CAPM model, there's a dividend model, dividend discount model, and the bond yield plus risk premium. So talking about the capital pricing model, it states that expected return on equity is the sum of risk-free rate of the interest and premium for the bearing the market risk. So expected return minus risk-free rate, it gives you actually a premium return, a premium risk compensation, okay? A premium risk compensation. So beta itself, it measures the volatility or sensitivity of the stock of the specific company stock to a changes in the market return. So if the market return changes, and it shows by how much the certain stock will be sensitive to changes. Expected return on the market, and this is expected return of the market premium, risk premium, or equity risk premium. So the difference between expected return on market and risk-free rate, it is equity risk premium or market risk premium. And RF is representing, and this is basically called a CAPM model. So if you find this expected return on market, you're finding the cost of equity. You're finding the cost of equity. But your job, the risk-free rate is given. If this is not given, you will search it, expected return on market, to find it. If this, for example, estimated already, what is the challenging part in here is to find the coefficient, the sensitivity of stock of certain company. If the company is publicly traded, it's pretty easy. You just get the numbers and plug it and estimate your cost of equity. If company is not publicly traded, then you have to use different method, which is called pure play method, which we'll discuss later, if the company is not publicly traded. So when we get into the example, there is a comprehensive example is given. I'm going to go through that example as well to illustrate how it works in market using this variable. So if risk-free rate is 3%, expected market risk premium is 5%, the company is better, it's 1.2. And what is the company's cost of equity? You just substitute the numbers and estimate the cost of equity. Just pretty easy. You don't bother yourself much in here. And there's some alternatives to the CAPM, like alternative models can be used to capture the expected return risk factors that is incorporated in the CAPM. For example, we can use the factor model estimate the cost of equity. And in here, actually, we're mostly using the statistical programs to do that. But for this chapter, we will not be responsible. It's just showing you the alternative to the CAPM. So coming to discount model, dividend discount model assumes that the value of the stock today is the present value of the all future cash dividends received and discounted at a required rate of return. Assuming that the constant growth rates in dividends, like the dividend will grow at a constant rate, which we can rearrange to solve for required rate of return. So everybody is remembering this formula. Yes? Is there anyone who doesn't know this formula? I think everybody should know. And then we rearrange it to get cost of equity. Dividend 1 divided by P0 plus G. And we can estimate the growth rate, G, by using the third-party estimate of companies' dividend growth rate, or estimating the company's sustainable growth rate, which is given here. If the growth rate is not given, so there is a formula which is here. So 1 minus dividend payout ratio. So dividend divided by net income, earnings per share, and multiplied by, so here actually, this EPS. This is the formula. So basically we are using in DDM model some certain formulas to derive cost of equity. So you will be asked, please estimate the cost of equity through dividend discount model or estimate the cost of equity through the CAPM. If it's dividend discount model, you have to search whether the dividend one is given, whether the P0 is given, or growth rate is given. If the growth rate is not given, this is the formula. You can estimate the growth rate of the dividend. So there is a example is given with the current dividend. When it says current, okay, dividend, which means it's a D0, okay, it's a D0, it's not a D1. Let me just as we can see from the formula here, cost of equity is equal to D1 divided by price 0, but in here we are given the D0, so which means that we need to convert into D1, the D0. We cannot directly just estimate. So we need to put it in a year 1, the dividend. So the dividend should grow by 1 year with the growth rate of the dividend. And what is the cost of gadget company common equity? We are using the DDM model. So R equal D1 price 0. So we are given price D0, D1 we can easily find it. And dividend payout ratio is 20%. We just actually plug all the numbers into the formula. First of all, we estimate the growth. So dividend payout ratio is how much of the dividend paid. It's 20%. And multiplied by return on equity, ROE. And you get the growth of the dividend by the formula of this. Second step, you just plug all the numbers into this formula. D1 is D0 times 1 plus G. So D1 is equal to D0 times 1 plus G. This is how we estimate the D1. And in this way, the cost of equity we can estimate is 15% using the dividend discount model. And the third one, which is bond yield plus risk premium approach, requires adding premiums to a company's yield on its debt. So as cost of debt plus risk premium, this approach is based on the idea that the equity value of the company is riskier than its debt. So, but the cost of this source move in the same manner, So the topics in a cost of capital estimation is estimating the project betas, estimation of the country's risk premium, and using the upward sloping marginal cost of capital schedule. And we will deal with the flotation cost. So project betas. If you remember, estimating the through the Kappa model, let me just go back and remind you again. Here, there is a beta. Judgment is applied in estimation of the company's beta regarding the estimation period. And so periodicity of the return interval is appropriate market index. So adjustment for a small company stock. If the company is not publicly traded, and if we are estimating the project beta, then we need to look to the risk of the company or project and use the comparables. Like we need to select some companies from the same industry and estimate the beta on average and apply this average beta for this specific project, which is not publicly traded. When we select the comparable for estimation project beta, we ideally actually would like to find the company with a single line of the business from the same industry. And the line of the business match that the project is about. And this method is called a pure play method. So we use the beta comparable company to estimate the asset beta and then use it for the project company. First, we select the comparable, estimate the project for the comparable. I mean, we're selecting those publicly traded companies within the same industry, that we are working on a certain project which is not publicly traded. Then we unlever the comparable betas to estimate the asset beta, and we are levering the beta for a project financial risk. So these are the steps to estimate the beta for a project which is not publicly traded. We'll be following, okay, this. Here's the formula that we use it. To unlever the beta, we remove the comparables capital structure from the beta to arrive the asset beta. So we get this formula, we apply on the comparables. Then we lever back the beta, adjust for the project's financial risk. So levering and unlevering means removing the debt and adding the debt back. This is basically what it means. The person who invented this, he just shared us. I don't want to go how it has been derived, these formulas. But if you wish, we can go, but there is no need for it. Because at the end of the day, we are going to use the final version of the data, the final version of the formulas. So first, we use this one to find the beta for the comparables, okay? For comparables. Then this, once we've estimated, we use this beta equity to estimate for a project that we are trying to estimate the feasibility of that project. So this one, the first step, we use this formula to estimate the beta asset, because beta equity is given for each company. Let's say we selected 1, 2, 3, okay? For each, beta equity is given. So we estimate and we find the beta asset for these comparables. And we found this beta asset. This beta asset is used in the second formula for our project that we are estimating, which is not publicly traded. And the reason why we are doing this all is to find this beta in order to estimate the cost of equity through the CAPM model for the company which is not publicly traded. Am I clear?
Yes.
So
But
basically, one you should remember, first formula we use, actually initially what you should know why we are using the levering and unlevering the beta is to find cost of equity through the CAPM. This is why we use it. How we do it, we select, let's say, 3 companies or 2 companies, like which are publicly traded, and we estimate the beta asset for them. Once we've estimated the beta asset, the second step, what we do, we estimate the beta equity for our project or for our company, which is not publicly traded. And we find it, we just substitute into the formula, and we estimate the cost of equity. At the end of the day, we estimate weighted average cost of capital.
Excuse me, Mr. Fuziliyev.
Yes?
So levering and unlevering means putting on debt and taking.
First, yeah. Unlever means leverage. Leverage, it means a company uses debt to finance assets. When we say the company is leveraged, which means the company uses some debt to finance its asset. When we say the company is fully equity, is an unlevered company, which means that the company doesn't have any debt.
Okay, got it. Thank you.
Okay. Here's an example is given, okay? Consider the following information for project A and its comparable B company, okay? Project A is a company which is not publicly traded, which means the beta is not available. But company B is publicly traded. In the financial market, you can find beta equity. So in here, we need to find beta equity for project A because we are estimating project A itself. And we selected comparable B. So what we do here, we unlever, first formula we use, we just substitute, so beta equity for comparable. This is for comparable. So we put here 1.4 and 1 minus tax, debt over equity. So debt over equity here, 100 and 200. So this is the formula of beta asset. Unlever the beta, remove the capital structure for the comparable in order to estimate beta asset. Why we estimate the beta asset? In order to estimate the beta equity for a project which is not publicly traded. So we find beta asset for comparable, which is 1.07, and this 1.07 is used in estimation of beta equity for the project which is not publicly traded. And at the end of the day, we estimate the beta of equity for a project A, 1.23. The higher the number, the more sensitive the company is or the project is to changes. The lower the number, the less sensitive is. So sensitivity, it is equal to risk. Higher the sensitivity, more risk. So when you have a more risk, what you have more? Compensation. Okay, more return. Higher risk, higher return. Any question? It's straightforward, but when we have a one big comprehensive example, which I might solve it next class, that will really help us to understand the logic behind the weighted average cost of capital estimation. But up to now, I believe everything is clear. If it's not, just stop me and ask. Country risk premium is additional risk premium that is associated with doing business in a developing nation. So additional premium added to its risk premium, to the market risk premium, to equity risk premium, in calculation the CAPM itself. So the country risk premium or country equity premium is called as well as a country spread, as you see from the formula. Here's the original formula. And here's some addition. So you add a country risk premium. And I believe that Mr. Talgat is going to apply the country risk premium as well. It will be very comprehensive. So the marginal cost of capital schedule may slope upward with a higher cost for raising more capital. And the point at which the cost of capital changes is the break point. So there may be many break points in the same graph. So investment opportunity schedule is a representation of the returns on investment. So we assume that investment opportunity schedule is a downward sloping, and more company invest, the lower the additional opportunity. So there is, the company will invest in the highest return investment first, and followed by the lower yielding investment in more capital is available to invest actually. So the marginal cost of capital is a schedule representative of the cost raising for additional capital. So we generally assume that the marginal cost of capital is upward sloping, and more funds and company raises, the greater the cost for it, because they require more compensation for their contribution. So basically, as you can see here, it reminds us demand and supply curve. And this is the point, it's a break point where the cost of capital is derived. This is another approach, which is not that much famous, but still it is used. to estimate the weighted average cost of capital. Flotation cost is the investment banking fee, which is associated with the issuance of the financial securities. So to treat the financial cost, to treat the flotation cost accurately, adjust to the NPV, the project for moderate monetary cost of the flotation should be included. So we are given a problem in here. The project has got the NPV on 100 million. If the company issues 1 billion of the equity to finance this project, and the flotation cost is 1.2%. So what is the NPV after the adjustment of the flotation cost? So the NPV will be in here, just subtraction. So you just exclude that flotation cost, and that NPV will be. So it could be the case because of this flotation cost, the NPV could be negative. So we know that we estimated project, okay, and the NPV became positive. So you accept the project, but okay, for the capital budgeting, you have decided the long-term project, you estimated the feasibility of the project, you accepted, you said this project creates some value for the certain firm. However, how are you going to finance this firm? Are you going to finance through the debt or equity? Let's say you decided I'm going to finance this project through the equity. You issue 1 billion or maybe more than this. And sometimes it might happen that this flotation cost could be more than your NPV itself. Then it really creates a trouble for you, because at the end of the day, your NPV will be negative. Even though without flotation cost, your NPV is positive. So you should take into consideration the flotation cost as well, if there is some issuance of the financial securities that which is charged by the investment bank. Okay, this is the last thing that I want to discuss today. It's very short chapter, but very interesting. So there are some examples. I will solve it, but not now. I will solve it next time when we meet, but now I would like to take the attendance. I will take the attendance and I'll let you go. Rinat is here.
Yes, I'm here, Professor.
Ablayhan. Camila. Temirlan.
I'm here.
Azamat, he was here. Alessia. Gani.
I'm here, sorry.
Yeah, it's okay. I saw Gani.
Yeah.
Alexander. Park.
Yes, I'm here.
Okay. Alibek.
I'm here, Professor.
Nariman.
I'm here.
Marlen. Rustem.
Yes.
Jangir.
Here.
Vladislav.
I'm here.
Okay. Azamat Umirjanov.
I'm here.
Okay, great. If you have questions, ask. You are free to ask. If not, see you on Wednesday.
Lushan, will you be available today at 6?
6 o'clock. Yes, I'm available. We can meet.
Okay, through which link should I?
Same link. Is it you wrote to me now?
Yes, I wrote you, but I want to clarify. At 6 will be more convenient.
Yeah. 6. Okay. 6 o'clock. Let's meet at 6.
Okay, it's going to be like 30-40 minutes because so many questions I have regarding.
Okay. No problem.
Okay, thank you so much.
Thank you so
Okay,
much.
thank you so much. Bye.
Take care.
Bye.
Sorry, Professor.
Yes.
I have a question about homework. So I haven't finished yet and may submit with late submission. So until today.
I have to check it. Wait a second. I have to check the deadline, how much I put the time there. Otherwise, you will not
I
be.
think time is until 2 o'clock. The time
It was 2 o'clock,
there. Yeah, today.
and 2 is over. Then I have to prolong it.
Yeah.
Okay, I will put it until. Wait a second. Activity group 2 deadline is okay today. It was today. Let me change the deadline then. Here it was 2. I'll put it 8 o'clock. Okay.
Yeah, okay, thank you.
I'll put it 8 o'clock. So before 8 o'clock, you have to submit.
Okay, thank you very much.
Bye. Take care.
Have a good day.
You too. You too.